This conversation is with Jack McDonald, the CEO of PolySign. PolySign has raised over $153 million and currently works with over 200 clients building enterprise infrastructure, custody, and settlement solutions. So specifically, that means allowing large funds to safely store their cryptocurrencies. We talked about how they do that, the different techniques that are used today, which is mind-blowing, the trade-offs that are made as part of these techniques in safety, security, convenience, and much more. Jack is named one of the 20 rising stars of hedge funds by an Institutional Investor magazine and has been in the game a long time. So I learned a lot from Jack. I pried him deep on questions related to custody and how it all works, and he was very open. So I hope you enjoy this conversation. Here is Jack McDonald. All right, Jack, just like that, we're live. Appreciate your time hopping on today. I was diving into PolySign, and maybe I'll try to paint a little picture and then you fill in the gaps and tell me how you think about the business. But I understand PolySign as the parent company, effectively building enterprise infrastructure, custody and settlement. You guys have taken an approach to become regulated as a trust bank charter in New York City, qualified custodian. So I almost think of it as you are building high trust, deeply integrated with the existing traditional finance regulated world. You have your own blockchain that you developed internally. Your business partner, co-founder, is an interesting guy, super genius, and not the creator of Bitcoin, but leads a lot of the development of the internal architecture and more technical architecture. What did I leave out? Tell me how you sort of see the direction of the company and what you guys have created so far.
Well, I'm going to give you a solid A, Mike. I appreciate your homework there. I would say just a slight but important distinction. When we started PolySign 4 years ago, the objective was to build institutional grade infrastructure for digital assets, broadly speaking. And we decided to start with custody, which is the standard custody and trust subsidiary that you mentioned. And all the tech is being built up at the parent company, PolySign. We did just announce an acquisition of a business called MG Stover, really the OG of fund administration for digital assets. They've been doing it. They've been around doing fund administration since 2012, but started doing fund admin for digital and crypto in 2016, I believe. So that is a related service to custody. If you think about the big global asset servicing banks, the BNY Mellons and State Streets and Cities, Northern Trusts of the world, they all are at their heart custodians, but they have this surround sound of other services like fund administration, collateral management, et cetera. And so we're building that out. So we really have two operating companies right now, generating revenue, live clients, et cetera, the custody business and now the fund administration business.
And
but
custody,
everything else you said, I agree with. Yeah.
Great. I'm glad. I'm proud of my A. Custody, I think of as managing people's money, specifically holding onto it and offering the value to the market as security. Is there other core concepts you think of when you think of custody? And is there a specific market segment or how is the market sort of divided up in custody?
Our primary job as a custodian is to keep your assets safe. We don't manage your money from a standpoint of deciding what to buy or sell. So our clients do that for their clients, if you will. Our clients are all institutions, so we're avoiding by design the retail segment of the market. Our clients are all hedge funds, private equity funds, pensions, endowments, family offices, and ultra high net worth individuals. And so they're making buy and sell decisions. And on the custody side, what we do is we take a deposit in from them. We keep it secure. And when the client decides they want to trade it or move it or stake it or lend it, we have a role to play there in coordinating whatever transaction is desired with the respective counterparty that they want to do that with. We will build out our services. If you think about the precedents that exist in traditional finance and you think about prime brokerage is really a custodian that lends, gives you margin financing, could lend your stock to short They may trade for you, give you reporting, etc. Whereas if you think in the earliest days of like version 1.0 of custody, it's keeping the asset in the vault, if you will. There are other services that have evolved over time. And so I think and we're starting to see this already, some of our competitors have built out more trading and prime brokerage related offerings. We're at the custody side, focused on building the most secure storage vault that exists. We feel like we've done that with the leadership of Arthur Brito, who you referenced earlier. We partner with other firms to offer a best-in-breed service. If you want to trade, you can trade with whomever you want. We've got preferred relationships with Cowen Digital and FalconX. If you want to stake, you can stake a coin with whomever you'd like, and we support that. It's not a punitive relationship like some of our competitors want you to only stake with them. We've got an open architecture there. We're providing staking support to clients who want to stake with Figment or Blockdaemon. Just onboarded another one, Alpha Pro, yesterday. So we're building out the ecosystem. More and more services we'll do natively internally, and others we want to offer partnership opportunities to really pre-plumb, if you will, how the mechanics of that might look and feel, but all with the mindset that we're here to service our clients. And if our clients want to trade or stake or lend with a given counterparty, we want to facilitate that.
Okay. And taking it down a level of abstraction. So you described everything that you do, what you do, how, and then speaking more broadly about the industry of custody, how does it actually look in practice, or what are the types of offerings or the types of strategies that custody companies take? I'm picturing some of them have banks with armed guards, or like they're managing keys on paper in vaults with what are the different approaches? Because in many ways it is kind of secretive. They're not showing videos of like, here's our guard and here's how it's all done, which makes sense.
The answer is a bit complex, so I'm going to try to generalize here and stereotype. Early version 1.0 custody, and if you think about the kind of legacy definitions around hot versus cold storage has generally been thought of as being offline storage, unnetworked. And in the early days, a company called Zappa, which is really a pioneer in custody, literally had the armed sentries protecting bunkers in the hills of Switzerland. And there are other storage solutions that are keeping secret keys in galaxies orbiting the world and whatnot. Those can be really secure, but not necessarily desirable if it takes you a lot of time to access the keys that you need to transfer an asset to an exchange to sell or whatever you want to do with it. Keeping in mind that the digital asset industry works differently today than the traditional capital markets, where in traditional capital markets, the transactions settle on a post-trade basis. So if I want to buy Apple stock right now, I can call my broker and say, I want to buy 100 Apple stock, and I have today plus 2 days to fund the account. You want to sell Apple stock, you can call up your broker and say, I want to sell 100 Apple, and you've got today plus 2 days to deliver the shares. So everything settles on a post-trade basis. In crypto, if I want to buy Bitcoin, I need to get my fiat US dollar to the exchange and say, all right, I'm ready to buy Bitcoin. You as the seller have to get your Bitcoin, your keys, deliver it to the exchange, and then we settle. We trade and settle instantaneously. So if my keys are in a bunker in Switzerland, or if my keys are orbiting in a galaxy, in a satellite, there's some friction there. It might take a couple of days. It might take hours and hours to do it. Now, obviously, the industry has evolved a lot since then. And there are two different types of solutions that are in vogue today with some nuances. There are companies like Fireblocks and Copper, and there used to be others that were bought, a company called Curve that was bought by PayPal, Unbound bought by Coinbase earlier this year, that essentially sell, or license, I should say, self-custody software that utilize, among other things, multi-party computing or MPC algorithm baked in a software, which essentially shards the keys apart. You can think of a long 27-digit alphanumeric code, cut the piece into 3, store them in different places. That software that you would license as a hedge fund, let's say, to custody results in you doing self-storage. So you're holding those keys, or at least some of those keys. The alternative is you could hire a third-party custodian like us, or a BitGo or a Coinbase or somebody like that, and we hold the keys for you. And we are a qualified custodian. Some of us are regulated, some of us are insured, which we are, and we hold the keys. So a fundamental difference. You hold the keys, you license the software, shards the keys if you want to do that, or you could hire somebody, we hold the keys for you. And most of the certainly earlier custodians that are regulated and do the key holding for our clients use more of a hardware-based solution utilizing HSMs or hardware security modules. Think of tamper-proof servers that hold those keys that require a multi-sig sort of verification process to move. At Standard Custody, we utilize both. We built our own multi-party computing software rather than licensing anyone else's. We use the same sort of HSM cluster approach to storing of keys. And what's unique about us is we're the only custodian in the industry that has a blockchain, private blockchain that Arthur and David Schwartz, Ripple's chief cryptographer, who's on our board and an advisor to us, that they developed, that essentially allows us to run business logic and run that multi-party computing logic through our HSMs. And one of the net benefits of that is that the ability to access your keys is much quicker. Most of our larger competitors allow for transfer of assets on a batch processing sort of approach, where you would stand in a queue essentially, and twice a day they will move assets out of cold storage. And our solution, in part, given the way we designed it, just our philosophical approach, everything is done asynchronously. So you can move your assets whenever you want to, as long as your requisite number of approvals are met. So taking a step back, there's different models. There's, cold storage traditionally versus hot storage, where it's more on an exchange, more accessible, more vulnerable to attack. Cold storage, typically offline, tougher to access, more secure. And there's this increasing evolution and tension between the two. You talk to clients, they want the most secure while also being the most accessible to them, given that funded nature.
And it seems like this HSM, which is a hardware secure network.
Hardware security module. Yep.
Is that I'm picturing like when I picture the cloud, like Google Cloud or Azure, I'm thinking that there's a building that's locked down with a dedicated network internally that's operating among the computers or the servers inside that building. But it's the ins and outs of that network to the internet is where the magic is. That's like the front door that you're.
Well, I'd have to kill you if I told you where the front door to the HSMs was. we don't want to go there. But there's, I think that's, that's largely right. We run our software through AWS sort of configurations, right? And so in the same way that you would envision, a lot of software being run where you've got the support of endless servers, and you kind of gain all that sort of computing capacity. The government runs their software there, et cetera. The HSMs are specific devices that have been used in banking for a long, long time and used in ATM machines. And they're very, they look like a server. They're very rote. They do very specific things. There's limitations around the scalability of them and whatnot. But the beauty of an HSM is that they are tamper-proof. So if you take a screwdriver and try to open it up, they're designed to self-destruct. So this is James Bond stuff.
Wow.
And so banks love them, and they've been used in financial services applications for many, many years. The crypto industry has embraced them because of the security profile around them. And specific to your question, we have de-risked even further the use of these HSMs because of the role they play by going to multiple vendors to buy our HSMs. There aren't many. There's 3 or 4 vendors out there. And we house them in colo facilities around the world, and we use different vendors with different geographic footprints. So one of our vendors has, I think, 10 locations around the U.S., And so we sprinkle our HSMs around different locations. And for each client that comes to us, they get a unique configuration of the vault using multiple HSMs in multiple locations or at multiple colo vendors that are sourced by multiple vendors. So it becomes this matrix, if you will, of security beyond a belt and suspender, a symphony of security, if you will, that these machines sit inside other big colo vendors. So we may be sitting next to a food delivery apps servers that's sitting next to a, fill in the blank, gaming company, and you would never know the difference. And there are, levels of security, not only armed guards, but you can have your own private cages, which we do, et cetera. But the idea is if you found one of our machines, they're tamper-proof, but you wouldn't know where the others are. So it's beyond a black swan event of how you would ever get a hold of them. And they need to be paired with the software that's running in AWS and other sort of software support platforms.
And the example earlier where you said a key would be split up and sharded, so you would need to have broken into multiple of these computers, HSNs, to affect and get into them and know what you're doing in order to actually...
And know where they are.
And know where they are, right. And so the business logic that does go in there and retrieve the tokens is that where the internally developed blockchain is utilized to extract and enter into?
You can think of a blockchain at its core. I think doing two things. Somebody I was talking to yesterday, I think, put it quite simply and succinctly and appropriately, which is blockchains replace trust with truth. And they also are a very elegant solution for bilateral transactions and storing of that information. And so we use our blockchain to do a number of different things. You can think of it as a bridge or a conduit of taking the multi-party computing software algorithms that we built and keeping that safe within the secure enclave of the HSMs. We need a mechanism to get that information into the HSMs. And we also store all of the encrypted approvals on that on that blockchain in an immutable way for regulatory purposes, audit purposes. Our insurers love it, et cetera. So every step of every transaction is stored and secured on that private blockchain. So if there was ever a need to go back and say, I was a little unclear, did Mike approve the transaction and at what time did Jack, authorize a withdrawal? Everything is stored there in an immutable way. So our blockchain serves a number of different applications. We require cryptographic proof before we instruct these HSMs to sign off on a transaction. And that cryptographic proof comes in a number of different ways. It comes from biometrics that we use when instructions are given in the solution. We also utilize these, they're called YubiKeys, which essentially think of a key fob, but they authenticate your identity. They prove you are who you say you are. And so when I go onto the system to move some assets, I plug my YubiKey into my phone or my tablet or my computer, and so it knows who I am. And it's just one more step in the process of securing an asset deposit or transfer on our platform.
This question is not meant to be morbid, but hypothetically, if you, your partner, everybody that knows all the intricacies of this network were to just get hit by a bus, is there technically any blockers or choke points at that point when no one has sort of access on the company side in?
So I want to make sure I understand your question. There's the question of what would happen if the hedge fund team got hit by a bus, who controls those assets? And then there's another scenario, what happens if we're having a standard custody outing and the standard custody team gets hit by a bus?
So, I guess I'm interested in both, but I was getting at the latter.
Okay, well, so in both cases, there is what we call a master key, essentially backup, and we hold all the master keys to our solution in an escrow account that is secured by a disparate group of service providers. You can think of lawyers, auditors, et cetera, who hold a portion of a key to a portion of the solution that would all ultimately come together. And we became regulated in New York by the Department of Financial Services. That was part of our application of how we would protect client assets in the event of a disaster scenario, something tragic like you just suggested, or in the case of insolvency, et cetera, so that ultimately the assets are protected in that regard.
I certainly don't want to pry too much because I know this is super sensitive, but so feel free to say, hey, I can't talk about that. But is when the master key is all the people who hold it, I imagine they know what they're doing. There are companies that are controlling this part of the key. And you could even speak more broadly about how this infrastructure would be created at any company. But the request to divulge the key, say if I went to the person who's holding a part of the master key, would that be a technical request, like coming from the network somehow, or would it be a phone call from a regulator saying, hey, this happened, this is the situation, we need you to give part of your master key? Does that make sense?
I would say a combination of both. Let me just kind of leave it at that. There's no one code you type in and everything gets unlocked, and you can't be, hey, I'm Joe from the feds, please, surrender all the assets. So we've got, mechanisms in place to ensure that we would only be doing that in a fully authorized way.
Yeah, it's not like somebody calling in with an accent saying, hey, this is IRS, I need you to send those over. Right. Super interesting. Man, what an incredibly valuable and I would imagine difficult and because there's such a trade-off, right? Like you can make it absolutely secure, but then it's completely immobile. Was there iteration of this design?
Well, there's a tension there. David Schwartz, who I mentioned earlier, said to me once, and it's just stuck in my brain, that you can build the most secure solution available, but if nobody can use it, what's the point?
Right.
Kind of thing. And so there's this, and that's where it really gets difficult. It's about building something highly secure, but very accessible.
Yeah.
And how we do that, we think we've got a leg up on the industry by developing the blockchain with the capabilities that we built into it that helps us in that regard.
Mm-hmm. Yeah. And I guess having insurance layered on top of it takes off a layer of anxiety where, I imagine that process was thorough and extensive to have an insurance provider. But if it were to all get hacked, hypothetically, at least customers would know that it's insured.
That's right. And when I started in this business 4 years ago, and you would have asked me then what I thought one of the biggest operational hurdles would be to overcome to get institutions to adopt it, I would have said insurance by far. And what I found quite surprisingly to me at the time is the support from the insurance community. I just returned from a trip in London where I was meeting with our underwriters 2 weeks ago. We used Marsh McLennan, who's done a great job bringing together basically a Lloyd's of London syndicate of underwriters who we currently have insurance with and are meeting with again for our renewal process. So I should say nice things about them. But the underwriting community has embraced crypto, I think, in a very thoughtful way. They don't underwrite everybody, obviously, and depending upon your construction of your platform, they take a different view on how much insurance they're going to give, the costs around premiums, what events they would insure for or not. There's different types of insurance. There's theft of assets, and there's theft, they're called crime insurance. And then there are theft of machinery, for example. If I were to go steal an HSM that's covered under something called species insurance, we care more about the theft of assets because that's what clients ultimately care about. But the short answer is yes, there is insurance. It's become, while not required from a regulatory standpoint, it's become table stakes from a competitive standpoint. Mm-hmm. But you really have to have it if you are going to compete for the type of mandates that we want to be competing for. And it's something also that I remind clients of. I think there's this comfort that institutions and retail investors alike have in the traditional capital markets that I'm at, fill in the blank investment bank or commercial bank, and all of my accounts are insured because it's FDIC insured on the door. And I'm pretty certain that the limit on any given account FDIC insurance is either $150,000 or $250,000.
Wow.
So if you have $10 million in your brokerage account at Goldman Sachs or Chase or, wherever, you have a limit in terms of what that insurance is. You think that you're fully insured on your $10 million and nothing could ever go wrong, when in fact there is a limitation of that FDIC insurance.
Yeah.
And so in many cases, many of the digital asset custodians like Standard Custody actually offer our clients a much better level of insurance than their traditional equities, public equities, or USD, sitting at your Chase Bank would actually provide for you.
Yeah. It's interesting because even the FDIC insurance is backed by the government's ability to reimburse that. Which is really backed by the US dollar, and what. Well,
and it used to be the gold reserve that,
right.
we depegged, for want of a better term, back in the 70s. And so now it's in God we trust. It's faith in the US government that is, backing ultimately the ultimate backstop, right? Do you believe the government's going to be there for you? We don't have to get into that part of the conversation.
Yeah, amen. I mean, well, I do think you could make it. I'm curious if you disagree or see it differently than this, but I would see that. I think of it as a couple of things. A couple of vectors are going on. One is that the U.S. government has been demonstrating a fairly, I'd say it's almost consensus view on fiscal irresponsibility that has led to a large-scale inflation that doesn't seem to be slowing down. And every day is like new news. And then there's also the effect of Bitcoin, specifically crypto more broadly, but Bitcoin as replacing the value that gold has traditionally offered, and USD has kind of pseudo offered in stability of value accumulation. And I would see this. This is where I'm curious to hear your reaction. Is the retail investors to the large-scale investors, the LPs, the pension funds, so on up the chain, so you get to governments or like Apple storing their cash balance in Bitcoin. Where are we along that spectrum of companies and large funds moving into Bitcoin and seeing it as a place that they can both gain stability, maybe gain resilience, security? Like, how are these large companies and funds thinking about this, and what's the trigger point? Because I'd imagine it's all about risk, reward, and opportunity. If US dollar is very stable, there's not a huge incentive, but today it seems like the calculation has changed.
I saw a cartoon on Twitter an hour ago that had two lines. There was two booths, and one booth had BTC 65,000, and the other booth had BTC 20,000. And there was a long queue of people at the BTC 65,000 and nobody in line at the BTC 20,000, which really just speaks to FOMO and the herd mentality and whatnot. I think there is less demand today than there was 6 months ago from corporates and others who wanted to move assets off their balance sheet, fiat USD off their balance sheet into crypto. Obviously, Michael Saylor and MicroStrategy has done. They're probably the most foremost in that, and depending upon what hour, what day, Elon Musk at Tesla is doing that or not doing that. But I still think it's a credible alternative for a number of companies if you think about alternative stores of value. I think one of the challenges in the near term is that the thesis that crypto is the ideal hedge against inflation hasn't worked so well in the last 6 months. It's unclear longer term, 6 months ahead or 6 years from now, whether we can look back and say, actually, there was this uncorrelated sort of profile that crypto offered vis-a-vis interest rates, inflation, et cetera. But if you look at just the last 6 months, it seems pretty correlated. And that would be one of the motivations, I think, for institutions to move assets into crypto, Bitcoin, as a store of value that would protect against the inflationary hedge against that. I think it's far too early to write that off as a thesis. I remark on it because it's something that got a lot of press and attention over the last couple of years. And the cynics are rejoicing. They're shouting from the balconies right now saying, aha, I told you so. Look at what's happened. You tell me what the interest rates concern are on the market, and I'll tell you where Bitcoin is trading. And Bitcoin's been trading, I think it's more, and you touched on this, more of a risk on, risk off sort of asset and trading mentality that's going on right now in the markets. So I was reading earlier a couple articles about the CPI number today and much higher than expected, highest inflation rate in 40 years, and Bitcoin trades off immediately as the markets sell off. And, it's kind of trying to find a base here. But I think we have to let a little more time play out before we draw any conclusions. I'd also note with interest that Bitcoin and crypto hasn't been around during a recessionary period. I'm going to take the post-COVID short-term period and not call that a recession in the true sense, an economic, recession. I think that was a bit of a corner case. But it will be interesting to see how crypto plays over the next year, 2 years, 3 years, vis-a-vis the broader economic trends that are happening here.
Yeah. Yeah, I would imagine one maybe underappreciated aspect of this is the distribution of ownership of the Bitcoin. So if you had, say, for instance, if you were to peel back the onion and you could see who are the demographics of the people owning Bitcoin, there's certainly like retail investors in the Western world, dominated probably in the US, that are putting in $1,000 to $20,000. And then there's institutional investors who are investing either their own money or other people's money on behalf of them, and they might have 500K to 10 million. And if you were to have a pie graph of these demographics, I would imagine it's going to be heavily skewed towards the US and heavily skewed towards retail investors, with upscale investors or larger funds less a percentage of that pie. And I would imagine that as two things change, one, the distribution of the owners of Bitcoin geographically spread across the world, then it becomes more resilient to the USD inflationary rates, as well as the owners of the larger funds participating in BTC then also provide resilience, because they're not as whimsical, right? They're like, if you run a $100 million fund, you're not going to pull it out as soon as some news comes out. Does that align with how you would think about this conceptually?
It does. And I think it's impossible to measure accurately, but I still think the retail ownership slice of that pie is larger than the institutional ownership. And I think a lot of the selling that you've seen over the last 6 months has been more retail selling or speculators selling. They're all, and you can see how this story unfolds with the economy shifting a lot over the last 6 months, inflationary pressures, the war, certainly affecting the price of fuel at the pump, all the trickle-down shortages in the supply chain, cost of food going up, et cetera, stimulus checks no longer coming in, people starting to go back to work, commute, I've got to go to the dry cleaners, all these sort of things. The cost of living has gone up, and wages have not been consistent with that. And so the average retail investor who made some money in some cases or lost some money are indiscriminately selling because they need this investment that they've made into crypto as a source of funds for living, and or they're concerned about what the future holds, and this is considered a risk asset, and so they're not going to sell necessarily their 401k or their RIA, but some of the more speculative bets that they've been making, and I choose those words specifically, I think are opportunities for them to unwind those bets and put some more money in the bank, where, not saying inflationary pressures devaluing the asset, you've got at least some sense of assurancy that money isn't any more at risk than whatever you might speculate around inflation rather. I do think, and I just want to clarify two things on my question I gave you earlier. I took your question specifically to ask around the use of corporates and moving balance sheet, shifting away from fiat towards crypto. I do think, and we are in touch every single day with institutions who are either investing into crypto and digital assets today or preparing to. While the market has pulled back, there's certainly some that will have delayed plans to invest or have been selling. There are, I think, more who are looking at this as an opportunity to invest at a very attractive level. If you have a long-term thesis that there's a role for crypto to play, you should love it at 20,000 as opposed to 60,000. And there's a lot of smart people thinking we've got another downdraft and this could go as low as 10,000. And that's, you got to pick your bottom or you start scaling in at these levels. But I think that there are, and we're seeing it in the type of inbound interest that we're getting. There are a number of large institutions who are pulling forward their plans to invest. They've been able to slow things down. There's a lot of power of the crowd, momentum, FOMO. When it goes from 40 to 50 to 60, you think you've missed the train and you're rushing, and now you're retrenching a little bit. But the point is you've got a little bit more time to be thoughtful about how you want to wade into the waters, the service providers that you want to utilize. You're asking different questions because some of the challenges that the industry is seeing on the lend borrow side at some of the exchanges, at some of the stablecoin projects out there. So I think there's going to be a flight to quality for institutions. It may take a little bit longer, but I think the demand is still very much there, and it will find good homes with either private equity, VC, or crypto, more liquid managers who are getting allocated to. And it's certainly going to be the case on the service provider front, where institutions are making, I think, more prudent selections in terms of who they're going with. Mm. The other thing, just a point of clarification that is worth noting, is that we spend most of our time talking about Bitcoin. We think about as a business the digital asset ecosystem, which is much broader than just cryptocurrencies. And the taxonomy, I think, is really relevant and important here. We think, and I think about cryptocurrencies as a non-sovereign backed virtual currency, Bitcoin, peer-to-peer, whether it's a store of value or a means of exchange, as opposed to a much broader set of assets that will benefit from tokenization and digitization over time. That could be a real estate building. It could be a private equity or VC fund. It could be a pre-IPO company. It could be a corporate bond. It could be an equity. Apple Computer, could get tokenized, and those tokens could trade much in the same way that shares trade today. But there could be some efficiencies around transparency, and equities are probably the least low-hanging fruit, if that's a term, because there's pretty much a great deal of efficiency and transparency and liquidity in them. But some of these tougher to value assets or less liquid assets would really benefit from tokenization. And I think there is a slow but steady and increasing demand for that type of product in the market that will accrue to the benefit of individual investors. And all of the big banks that are in the industry, in the traditional capital markets industry, have a view or developing a view on future tokenization and digitization, having nothing to do with cryptocurrencies. So it would be a very common refrain for a big global investment bank X or global custodian Y to say, crypto maybe not, or crypto no, but blockchain, yes, because what's underpinning both cryptocurrencies and these other digital tokenization products is the underlying blockchain technology and distributed ledger technology. And that's the part of the business that excites us more, frankly, because it's a much bigger addressable market that will have a more profound impact on capital markets as we know it than cryptocurrencies, which may or may not have a future, long-term role.
Yeah.
Jury's out on that.
Yeah. Interesting. I've interviewed a few people who are working on specifically the idea of connecting tokenization to real estate, both on small scale commercial real estate and large scale. There's a guy I interviewed recently, building a company, Citadel, I think it was called. And one of the things I learned that was interesting is the unique innovation there that he explained to me, it took a little while for me to understand it, was that the title that represents ownership as recognized by the government, in this case, Singapore government, is typically, and the hard part is to get ownership of the title to be connected with the DAO or the ownership distribution of the token. So how do you connect ownership as recognized by the government with the ownership of the token? And that's where we could say more about that, but that's where their innovation specifically is that there's a company that owns the DAO that is recognized by the government, and that distribution of ownership in the company that's on the title is what's represented by the tokens. And so you can have a real liquid market there because you're effectively trading tokens as representative ownership of a company that's recognized by a government, because it always, real estate always traces back to government recognition of who owns it, because that's, at the end of the day, that's what matters.
Yeah, well, to legally transfer that title and whatnot, and pay your taxes and everything, right? It all starts with the records that are on file. Ultimately, where that probably goes, though, is the government should be utilizing a blockchain for real estate title transfers, et cetera, right? I mean, I think real estate is such an obvious industry that will benefit from blockchain technology.
Yeah,
the whole title search business, I think, is a structural short. It should go away. It shouldn't exist. You should be able to go to your bank and say, I own the home, you own the home, I want to get a loan out. Whoever's going to lend you money should be able to look on the blockchain and say, okay, it's clear that Mike owns the home, there's no lien on it, and not have to go to a title insurance company, pay them $5 or $10 to tell you and them what you already know. It's crazy to me. And that technology, this is one example of a place where I think blockchain technology will have a profound impact. Medical records, gun ownership, don't even want to go there. But it's crazy to me how decentralized our record is for, gun ownership. There should be a central ledger. You could see everybody who's authorized to buy a gun and
and have the identities be connected to a private key that you then, so it's like you can pseudo-anonymously see what people own, but collectively it's all stored in one place.
Sure. And in the case of guns, I don't want to get off on a
that's fine
tangent, but something I care deeply about is it's crazy to me that I think the authorities should be able to see who owns guns and who doesn't, my personal view. I'd rather not have them, but if we're going to have them, it should be very clear who's licensed to have one and who isn't. It should be easy information to find. You shouldn't have to go down to Joe's Bait and Tackle on a paper notebook to say, Mike bought a gun 2 weeks ago and I took his ID and, here's my record of it.
Right. More something similar to the DMV where there's licenses that you have and maintain and renew.
That's right. That would be transparent to anyone authorized to see that. So other regulatory or other law enforcement organizations, it should be transparent, and the technology exists for that to happen. Yeah.
It is interesting to think about the influences that cause regulation to change much quicker. Like I think about the pendulum where it currently at with financial regulations as it pertains to institutional and accredited investors, institutional versus accredited investors, is, the SEC has largely opened the gates to retail investors getting access to private deals. Whereas before, you had to be an accredited investor to invest in a company. Companies couldn't solicit private company fundraisers publicly. And when you allow that to happen, innovation, economic activity flourishes. And so to your point on real estate, that seems like a clear case. Anytime you allow any value to be exchanged in a more liquid fashion, guns would be separate though, because there's not an economic incentive.
That's right.
Right.
I'm just thinking about the utility of having a common ledger that everybody uses. Because when you decentralize that and everyone's got their own ledger, which going back to capital markets, DTCC has their ledger, Bank A has their ledger, Bank B has, if you think about everybody sharing a common ledger, you think about all the efficiencies, and that's where you start to get into instant settlement. You lower the counterparty risk, you lower the friction, you lower the cost, you lower the time, et cetera. And so in a similar sort of way, I mean, that's one of the powers of a blockchain, whether it's a public or a private or a hybrid chain, is that you replace, as I was mentioning earlier, trust with truth. This becomes the orb. This is the golden copy of the truth that is transparent based on whatever sort of permissioning is appropriate, for all to see.
Do you see, maybe take the U.S. as an example, do you see government as being the current blocker to innovation on that front? Or is it manpower, engineering power, capital in the market to fund projects?
I don't think there's one answer. I think there is in the area that we interact with the most on the institutional or regulated custodians you touched on earlier. The other part of our business, by definition, is the industry of fund administration, not regulated. Some of the other things that we're building will be regulated cross-border. I think getting regulatory clarity undeniably will be a major advancement for the digital asset industry and for capital markets as we know them. And the sooner we do that in the US, the more innovation will happen here, in part because more investors, institutional investors, will have the comfort of wading in to the space. Right now, I think many are waiting for regulatory clarity before they come in. And I think also from a competitive standpoint, we'll see more innovation here in the US than elsewhere. One of the challenges is that this is very much of a global industry. And if the US doesn't clarify what they need to see from a capital markets and a market structure standpoint, there will be more and more innovation, which is already happening, going offshore. But I think having demand from institutions will help fund more R&D and more development. So they are interrelated. But I think the crux of your question is, should we be doing more as a government here in the U.S.? The answer to that is yes. We've seen some green shoots. I think the executive order of a couple of months ago actually was a constructive step because it said there was a there. And what Biden did was essentially instill a sense of urgency, quote unquote, with the respective regulators to actually start looking into this and start regulating the industry. The recent legislation from Senator Gillibrand, I think, was a very credible step forward to say, hey, here's an attempt to lay out a framework. That'll be picked apart and debated and whatnot, but at least we're starting to make some strides. Gensler's come out with some commentary of late around his concern around segregating exchange-related activity from custody. We think that's very constructive and in line with our thesis in putting the business together. And so we're starting to see some advancements. It can't happen quick enough, in my mind, or comprehensively enough, but we welcome regulation. We think it would be a good thing for the industry. And I think most of the service providers, as well as institutional investors, would actually like to see more regulation come here, because it's really challenging running a business when you don't know where the guardrails are.
Yeah.
You're being told not to speed on the highway, but I'm not going to tell you what the speed is.
Yeah.
Right?
Yeah.
So.
Totally. And I imagine the trade-off internally in the government is the sophistication and accuracy. Maybe those aren't the right words, but the degree at which the regulations allow for their proper intentions. So versus speed, you could come out tomorrow versus have something that is more robust.
That's right. You don't want to screw it up. And I think as controversial as he's been, Jay Clayton's been, I think when he was at the SEC, I think appropriately speaking about how the structure for looking backwards has actually done a fairly good job of protecting the end investor, which is really what a lot of these regulatory schemes are designed to do appropriately. The challenge is we can't use the past to regulate the future, because there's just such fundamental differences in how the technology works and the sort of products are being brought, the 24/7 nature of where you can buy crypto all around the world, multiple exchanges, et cetera. And so it's that challenge of taking the lessons learned from the past and recalibrating them and taking kind of a best of breed approach and some new learnings and coming up with a construct that's going to be conducive to innovation and protective of investors simultaneously. And I don't envy the job of the regulators to come up with that framework to see what it looks like. And the consequences are dire if you get it wrong, right? So they'll probably overshoot, the restrictive elements of the regulation to start in the interest of being more cautious. And I understand that approach. We've seen it. We're most closely working with the regulators in the New York Department of Financial Services. And I think they've done a very good job over the years of being very solicitous of input. They want to learn. And I think even in the relatively short period of time, 2 years or so that we've been working with them, we've seen a lot of really smart people come through. And we think that, the initiatives that they're taking of trying to evolve their thinking, to be open-minded and to embrace the new technology and to blend that with a regulatory framework that will work for all, I think they're taking their job very, very seriously. And it's a very tall order.
Yeah. A couple of things I'm curious about. One, why New York versus another state? I know New York has obviously been the financial capital of the world for a long time, but other states like Wyoming seem to be carving out niches in more of a open-minded, more, I guess, maybe like libertarian perspective and clarifying regulation. Had that been an internal debate you guys had? And what was that like? Yeah,
we had a big debate about it. And ultimately, we chose to go for the kind of the highest regulatory hurdle in the land, which New York has, because ultimately we felt like that would serve our institutional clients best. Also, by being in New York, we're exempt from needing a BIT license. If we were to be in another state and wanted to do business with clients domiciled in New York, you have to get a BIT license. BIT licenses are given by the same Department of Financial Services that gives the trust company license, and no other non-New York trust company licensee has been successful in getting a BIT license. And so we want to service New York institutions. We feel like the cachet of being regulated in New York is beneficial to our business and our brand. And we wanted to remove an obstacle that a lot of the New York-based financial institutions would have in wanting to use us. We can work with other regulated New York financial institutions who may want to appoint us as a sub-custodian. And we actually think that the framework there is constructive and will serve us well in the long haul.
Yeah.
It's also recognized most outside the U.S., so we have clients in Europe and Asia where we can support them through our New York charter, and so it goes a long way from a kind of a brand building and a regulatory recognition with other jurisdictions.
One thing I haven't quite been able to come up with a story that is cohesive for my narrative on, but I view there's some parallel, something consistently and predictably happening in places like SF, New York, where they've accumulated this almost critical mass of expertise, either in tech or finance. And maybe it's a collective social exploitative process where New York tries to keep everyone out. They make their walled garden really high. They build the walls high. They make the rules tough. They make the taxes high. And then the rug is pulled out from underneath you. In the case of SF, it's COVID. Oh, we can work anywhere. So why be an SF? In the case of Wall Street, it's, crypto. So your traditional finance businesses are now not the talk of the town. Does that way of describing it align with your understanding as to why these places seem to be on their heels in attracting top talent, top companies? Like, you guys made a decision to go there consciously. You're like going into the, level 9 boss because you want the credibility in the clients that are there. But many people say, I'm not going near New York. I'd rather, go get the low hanging fruit first.
Yeah, it was certainly a deliberate attempt, and I would make the same decision today based on my experiences over the last couple of years. It costs more, it takes longer, the hurdle's higher, the amount of diligence we go through is much steeper. But at the end of the day, it makes us a better firm, and it's ultimately going to make our business more successful. I firmly believe that. As it relates to San Francisco, I think a lot of it has to do with cost of living. We were talking about this before we got started. These are expensive places to live, whether in New York or San Francisco. And one of the things that COVID taught us is that more and more people can work effectively remotely. And if that's the case, then maybe I can move to Lake Tahoe, or I can move to Oregon, or I can move to be with my relatives in Omaha, Nebraska, or wherever it is. And there are pluses and minuses to that, like any sort of transitionary period. One of the positives for us has been the ability to, and interestingly enough, when we started the company, given the heavy engineering focus that we had in the early days, we still do, but the team now is broader than just engineers. But for the first 2 years, it was just engineers and me. Was the need to work in a very kind of quiet, secluded way. So pre-COVID, we were working 2 or 3 days from home every week anyways. So it was a very easy transition for us. One of the things that has been a challenge and an opportunity for all companies, tech companies specifically, is now the opportunity for us to hire the best talent has gotten wider in terms of where people are located. So we've got engineers in Texas and in Chicago and in Virginia and in Nashville, Tennessee. Whereas if we kind of old pre-COVID days would have required them to be in San Francisco because that's where we all were. And so now all of a sudden, in some ways, it's easier to hire people because not only do we have a remote work first philosophy, but we also were able to attract talent elsewhere. And that's just in the U.S., and we're considering doing more in the near shore or offshore. Client service is a different sort of component. And while we have our client service people and salespeople working remotely, I think where there's more direct client contact, we're going to want to be building out presence in New York. We've got an office in New York. We've got an office in Denver through the acquisition we made of MG Stover. We'll soon have another office here in San Francisco. And so I think we're going to have a hybrid sort of approach. And depending upon what your role is, will dictate whether or not you're more in the office versus less in the office.
Yeah. Yeah. Sometimes I worry about New York. I worry that that there's a kind of collective subconscious arrogance that is pervasive throughout the traditional finance world. And that feeling like you have to be in New York if you want to build a finance company. Like, it makes sense for you guys because you're selling large, high net worth funds and businesses. But if you're starting off, most companies start off selling to retail investors, whatever the product is, 90% or so. And New York seems to be repelling that. And I wonder what the driving motivation is, if it's just purely the clout and, barrier to entry they've gained in the traditional finance world, and how they adapt and what this looks like. Does it look like Detroit, where it's like the industry is just vacated and they go through a massive depression and no one wants to live there? San Francisco is not there, but it's like, I hope they turn it around. It seems, I don't know. I'm trying to make sense of it or articulate a vision and a pathway forward that doesn't end in economic depression in a city.
Yeah, well, nobody would like to see that. And I think about it just at kind of level one, building a business, particularly, I've been in financial services my whole career, so it's the world I know, but I want to be close to where the clients are.
Yeah.
And so if the clients are in New York, I want to be in New York, or if they're in Greenwich, Connecticut, I want to be in Greenwich, Connecticut. I want to be in San Francisco. I don't want to be in Coeur d'Alene, Idaho. It's a beautiful place to live, but there's no clients there, right? And so as long as the clients are in New York. Now, to your point, that's been changing. COVID hopefully will end here soon, and maybe everybody comes back, or maybe all the hedge fund managers say, gee, I kind of like Florida in the winter and Connecticut in the summer, or Maine, and there's fewer clients there. And over time, the banks say, well, geez, I don't necessarily need to have a tower in Manhattan. Maybe I can be in Jersey City, or maybe I can be in Tampa, Florida, or I can be in Cincinnati, Ohio. So I think it'll take a long time for that to unwind. But ultimately, the sell side follows the buy side. And if the money being managed is in New York or in London or in Singapore or in Hong Kong, you're going to see the sell side, the investment banks, the technology companies, the fund administrators, the trading firms, et cetera, hovering around. They move to where the cheese is. And so I think it's, you tell me where ultimately the money managers are going to be in financial services, and I'll tell you where the service providers are going to be.
I dig it.
At least having an output.
Yeah. Are there any particular perspectives that come to mind when you think of things that are commonly put forward as narratives, either in crypto, traditional finance, politics, economics, that you feel like are wrong, that the world thinks we're going this way? You think we're going a different direction, a contrarian perspective?
Full disclosure, I'm an eternal optimist.
Love it.
So I tend to root for the good outcome and think that ultimately, things have a way of generally working out. I think there seems to be so much pessimism right now on not only the economy, but on the digital asset market. And I think it's really too early to call yet another death of crypto or death of digital. I harken back to the fact that the internet didn't go away when the dot-com bubble burst in 2000. And I think we're in this kind of narrow window right here. I'm increasingly excited over the last 6 months, just because of the conversations I'm having with this longer term thesis around digital tokenization and digitization of a broadest possible range of assets. And I think we're going to look back 3 to 5 years from now, and that theme will have been played out in a really meaningful way. And I think we are in the early innings of rewriting a new operating system for capital markets. I own a lot of crypto, and so I hope it goes up, and I don't know when the bottom is. That will kind of follow along. But I think the lead story, which people are somewhat missing, is this broader tokenization and digitization.
Yeah. Yeah, I like that. Jack, are you writing online, tweeting? Do you want to throw out any personal handles or places? We'll have all the PolySign stuff in the show notes.
Yeah, we're doing more and more on social, looking to bring in a new head of marketing. I am on Twitter. and you can find me there. And I'm learning more and more of the power of social media as I am 56 years old. So I've had to learn a new skill set over the last couple of years. But it's been a fun and really interesting and exciting industry to be in. And I'm very stoked about the future.
I love it. Eternal optimist. I need to. That's my internal perspective too.
A better way to go through life, Mike.
Dude. It's really the only option if you really boil it down. Otherwise, what's the point of doing it if you think it's all going to crash down? At least believing that there's a pathway forward. Like, okay, great. Well, things look shitty. Well, there's an asteroid headed to Earth. Well, let's fucking do something about it. Let's at least step up and take on the challenge. So and we're not even close to that. So that would actually be a thing that just trumps 1,000 X's of whatever problems we have here on Earth.
I also find that the quality and caliber of people who are in this industry, broadly speaking, is really encouraging and it is refreshing. And I learned so much. I mean, what I love about my job, I love a lot of things about it. The team we have working with us is just off the charts, phenomenal. The people that I meet just day to day, I'm always out talking to folks, whether they're clients, folks like yourself, other service providers, and it's person after person.
Yeah.
People really are fighting to change in a positive way some of the problems, and not going to the extent of saying, the world is screwed up and I've got this kind of visceral view towards the incumbency or big institutions of the government as much as, and that I think may have been part of the founding fathers behind the crypto movement. But I think what I hear more and more of today is how can we leverage technology and work it into the current system to generate a better result for everybody. Mm-hmm. And that's it's an honor to be a part of that movement.
Yeah,
it really is.
There's so many smart people in crypto. I just wish there was more smart people in politics. That's my only complaint.
Yeah,
Jack, thanks so much for your time, man. Congrats on all the progress with the business, and I hope you guys keep crushing it.
Thank you very much. It's an honor to be here with you. I love what you're doing, and I'm appreciative of this. Thank you.
Thank you, sir.